kind of taking a little bit of a red day because the commentary was hawkish. They were saying 2 rate cuts next year. Of course, we're going to see what Powell says in 9 minutes, but I know that the market consensus is like 3, and people were even saying like, "Hey, the most bullish would be if we do 4 or 5, or if there's commentary around that." But my comment that I just made was it's kind of reckless of them to promise things that they can't necessarily deliver because they don't know what the situation is going to be next year. If inflation comes back, if unemployment goes up, like all of these factors are going to be affecting what that decision is going to be. And I think that for them, it's better, like the game theory strategic move is for them to just be neutral to conservative so that it gives them more flexibility later on if they want to make further moves from that. But right now, the market is just pricing in the fact that, hey, maybe we might not have 3 rate cuts. We might have fewer.
No, I think that that's prudent for them to do. I agree with you there. I mean, it's easier for them, and it will get less volatility if you do it that way, rather than coming the other direction. I feel like what they've done in the past is almost signaled too early, and so I think that hopefully that's what the Jerome and the rest of the FOMC is trying to do, is recognize, hey, it might be better to lean on the air of caution this time, comparatively to what they've done in the past. So it'll be interesting to see. I'm curious to hear what their thoughts are. At the end of the day, 2 cuts to me seems low. But
Yeah.
I hear what they're saying. There's a regime change, right? I mean, you're talking about the Trump administration coming back, lower business taxes comparatively to what environment we are today. There's more certainty with respect to the extended individual tax cuts, which we're supposed to roll off at the end of this year,
Yeah.
and potentially are now going to be extended under the Trump administration, if not even increasing. So it's going to be bullish in terms of business, and it's going to be bullish in terms of personal taxes as well, in terms of people being able to take more. So lower tax rates for people, and they'll be able to take home more, which should mean you already kind of have a stimulation into the economy. So if you
Yeah.
do kind of show too many cuts next year, then it's only going to pour more fuel onto the fire. So I'm with you. Unless you start to see severe job slowdowns after the seasonality of December, obviously a lot
Mhm.
of people recognize companies like Best Buy, Amazon, they all hire more so in the winter time frame to be able to keep up with demand for winter shopping and things of the like. Eh, I think it's prudent. I like where your head's at with respect to that. So I echo your
I mean,
consensus
look,
there.
man, I just think that if the Fed was pandering to the market, which I mean they don't do, but if they were and they had said, hey, 4 or 5 rate cuts next year, we would be completely on a sugar rush right now.
Yeah.
Like, the market would fly to all. And the problem is, it's more detrimental for us later on because if that does not end up being the case, I mean, like, I don't know, like for SoFi, for example, last year was entirely the same situation because management was expecting 4 rate cuts or 5 rate cuts or whatever it ended up being. It ended up being one or two. I think this is the third one, maybe.
Yeah.
So my point is, it's far fewer than what they were expecting, and as a result, the stock got battered because of it. Because every single month we were finding out, hey, actually, it's not going to be as rosy as we thought it was going to be. And so I think that it's better off, more sustainable for the rally to take it one day at a time to say, hey, we were expecting 25 bips, we got 25 bips. We were expecting 3 rate cuts next year. They're all opening the possibility for 2 rate cuts next year. And let's go with that, right? Like if the actual economy is going to be good, then you're going to end up getting more rate cuts. Like it's not like a set in stone thing. And so right now, like you're going to have volatility in the short term because it's algorithmic trading and whatnot. But you know, over the long term, I think everything is still on track, right? We still got the rate cut today that we were expecting, and the commentary is just opening the door for fewer, and people are pricing that in, and that's all fine. But again, it doesn't mean that anything is for sure next year because we've had situations where it's been reversed, where the Fed has a lot of promises and then they don't keep up to those promises over the next year. And that situation, in my opinion, is actually worse off.
Yeah, I hear you. Are you ready to hear my gamble of the day? Because you got me in a gambling mood. Versus, I won't disclose what we were talking about before we decided to go live, because that was some absolute degeneracy. But uh, can I tell you what my gamble of the day is? And
Uh,
it's not anything to do with what we were talking about earlier. It's completely different.
sure.
So
Don't tell them my gamble of the day, but you can tell them yours.
I'll tell them your gamble. That no, I'm just kidding. So, well, I don't know what your gamble of the day is. You might have done some crazy stuff between the 15 minutes we got off the phone to now. But I decided I was looking at the market. I saw the initial reaction. It went down to the SPY went down to like 601, maybe a little bit below. And my thought process is whether or not it's right or wrong, if we are going to hit some sort of short-term bounce period, it would be off the 6,000 on the S&P 500. And so my thought process was when it got down to 601 or 600 and change, I bought the 601 calls for this Friday for $2.50. That is a complete gamble, but my thought process is I like a good gamble, and I wanted to put some money on the line for when Uncle Jerome starts speaking. So uh,
Hey,
I bought those for 250. They're now hanging around 270 if I'm looking at them on the ticker. So I should probably sell them and get my $40 profit. But I'm a gambling man, and so I bought two of those for 500 bucks overall. So we'll see where the 601s lead us.
we'll
Now they're at two. Now they're at 280. All right, we're climbing a little bit. So we'll see.
we'll check in on those at the end of the commentary. Fool's Gold donated $50 to you, so that's your profit right there. You
There it
can
is. I
afford
should
to
close
stay
it.
in them.
I should close it. No, Fool's Gold's a good man, man. I need to meet up with him. I need to learn from him. He's a wise businessman. I need
You
to be
already got
more
your $50 of profit. You're just gonna stay in it now. Who cares?
well, the profit is just coming on and seeing your beautiful face. Every time I come on here, I'm like,
Hey man.
is this a stock talk or is this gentleman quarterly? I don't know what's what is this?
All right. Well, the Fed is going to be speaking in 2 minutes, and I don't want to be blushing when Jay Powell comes on. All right.
Hey
So
man, I'll be blushing if these things go to 400 bucks. That's what I'll be doing.
yeah, I don't know that Powell is going to actually, pump the market. I think he's going to be fairly pragmatic, but we'll see. I mean, I don't know. We'll see.
We'll
Um,
see.
so about 2 minutes. I have it here in the background. It hasn't started yet. I will let you guys know when it does start. Let's roll the dice with Maddie. Yeah, Matt does some degen bets. We were on the phone like 50 minutes ago.
Don't act like I was the only one saying some degenerate shit on there, man.
No. That's why we're on the phone, because I'm also a degenerate, and it's great, man.
You
Some
talked
some
me into some. We'll see how that one turns out. The other one we were chatting about. Actually, I should keep my eye on that. You're probably losing me money at this point.
no. You're fine. Well, yeah, probably losing you money at this point. I, you're gonna end up fine. Okay, it's
50
gonna be
50. Yeah.
fine. All right.
Good.
So, Matt, do you
uh,
think we're gonna have two rate cuts next year, or what do you think we're gonna end up
Oh
having?
man. I mean,
Actually, let me start a poll in the thing, and then
yeah. Let's
people
get a
can
poll going. I mean,
poll going.
should I tell you what I want or should I tell you what I think?
Both.
Well, what I want is for them to cut as much as possible so that I can refinance all my damn real estate because all my mortgages are north of 6.75%. So it would be nice to be able to get a little bit of a relief on that, and it'll save me a couple thousand, probably actually overall. If I were to get all three houses refinanced, all three properties refinanced, would be able to get me probably 15 to 20 grand a year back in my pocket. But if it was actually going down to a reasonable rate, regardless, I'll probably still be able to refinance maybe in late 25, early 26, depending on where we're headed. But what I think is actually going to happen, man, I think right now we're in a state of euphoria with respect to how the market's been performing. And I'm not saying there's going to be some sort of black swan pandemic or anything like that, but I do think that there's going to be some sort of cooling off period once we kind of get into the middle of next year and beginning to middle of next year. Bitcoin will be through the roof at that point, but everything else will hopefully have cooled off a little bit, taken a breather, retraced a little bit. We needed a little
Sorry,
bit of a retracement. It's been a little bit.
sorry, Matt.
Get
Um,
get Uncle Jerome on here.
it's on. Let me know if you can hear it. Okay.
My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The economy is strong overall and has made significant progress toward our goals over the past 2 years. The labor market has cooled from its formerly overheated state and remains solid. Inflation has moved much closer to our 2% longer run goal. We're committed to maintaining our economy's strength by supporting maximum employment and returning inflation to our 2% goal. To that end, today, the Federal Open Market Committee decided to take another step in reducing the degree of policy restraint by lowering our policy interest rate by a 1/4 percentage point. We also decided to continue to reduce our securities holdings. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. GDP rose at an annual rate of 2.8% in the third quarter, about the same pace as in the second quarter. Growth of consumer spending has remained resilient, and investment in equipment and intangibles has strengthened. In contrast, activity in the housing sector has been weak. Overall, improving supply conditions have supported the strong performance of the U.S. economy over the past year. In our summary of economic projections, committee participants generally expect GDP growth to remain solid, with a median projection of about 2% over the next few years. In the labor market, conditions remain solid. Payroll job gains have slowed from earlier in the year, averaging 173,000 per month over the past 3 months. The unemployment rate is higher than it was a year ago, but at 4.2% in November, it has remained low. Nominal wage growth has eased over the past year, and the jobs to workers gap has narrowed. Overall, a broad set of indicators suggests that conditions in the labor market are now less tight than in 2019. The labor market is not a source of significant inflationary pressures. The median projection for the unemployment rate in the SEP is 4.2% at the end of this year and 4.3% over the next few years. Inflation has eased significantly over the past 2 years, but remains somewhat elevated relative to our 2% longer run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.5% over the 12 months ending in November, and that, excluding the volatile food and energy categories, core PCE prices rose 2.8%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The median projection in the SEP for total PCE inflation is 2.4% this year and 2.5% next year, somewhat higher than projected in September. Thereafter, the median projection falls to our 2% objective. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. We see the risks to achieving our employment and inflation goals as being roughly in balance, and we are attentive to the risks on both sides of our mandate. At today's meeting, the committee decided to lower the target range for the federal funds rate by a 1/4 percentage point to 4.25% to 4.5%. We've been moving policy toward a more neutral setting in order to maintain the strength of the economy and the labor market while enabling further progress on inflation. With today's action, we have lowered our policy rate by a full percentage point from its peak, and our policy stance is now significantly less restrictive. We can therefore be more cautious as we consider further adjustments to our policy rate. We know that reducing policy restraint too fast or too much could hinder progress on inflation. At the same time, reducing policy restraint too slowly or too little could unduly weaken economic activity and employment. In considering the extent and timing of additional adjustments to the target range for the federal funds rate, the committee will assess incoming data, the evolving outlook, and the balance of risks. We're not on any preset course. In our summary of economic projections, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate, based on what each participant judges to be the most likely scenario going forward. The median participant projects that the appropriate level of the federal funds rate will be 3.9% at the end of next year and 3.4% at the end of 2026. These median projections are somewhat higher than in September, consistent with the firmer inflation projection. These projections, however, are not a committee plan or decision. As the economy evolves, monetary policy will adjust in order to best promote our maximum employment and price stability goals. If the economy remains strong and inflation does not continue to move sustainably toward 2%, we can dial back policy restraint more slowly. If the labor market were to weaken unexpectedly, or inflation were to fall more quickly than anticipated, we can ease policy more quickly. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. On a technical note, we lowered the offering rate on our overnight reverse repo facility to align it with the bottom of the target range for the federal funds rate, its typical configuration. Technical adjustments of this kind have no bearing on the stance of monetary policy. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Gina Smilik with the New York Times. Thank you for taking our questions. I wonder if you could talk a little bit about why officials think it's appropriate to cut rates at all in 2025 if inflation is expected to remain firm throughout the year. And what would you expect at this point the timing might look like? Would a January cut potentially be possible, or does a pause next month seem more likely?
Well, so let me start by saying why we cut today and then move to 2025. So I would say today was a closer call, but we decided it was the right call because we thought it was the best decision to foster achievement of both of our goals: maximum employment and price stability. We see the risks as two-sided: moving too slowly and needlessly undermine economic activity in the labor market, or move too quickly and needlessly undermine our progress on inflation. So we're trying to steer between those two risks. And on balance, we decided to go ahead with a further cut, and I'll give you some details on why. Downside risks to the labor market do appear to have diminished, but the labor market is now looser than pre-pandemic, and it's clearly still cooling further, so far in a gradual and orderly way. We don't think we need further cooling in the labor market to get inflation down to 2%. Job creation is now well below the level, or certainly below the level that would hold unemployment constant. The job finding rate is low and declining, and other measures such as surveys of workers and businesses, quits, things like that, broadly show a much cooler labor market than we had in 2019. It's still quite gradually cooling. So we keep an eye on that. Inflation, we see that story as still broadly on track, and I'll tell you why. We've made a great deal of progress. 12-month core inflation, as I mentioned, through November is estimated at 2.8%, down from a high of 5.6%. 12-month inflation has actually been moving sideways as we are lapping the very low readings of late last year. Housing services inflation actually is steadily coming down now, albeit at a slower pace than we might like, but it has now come down substantially, and it is making progress slower than hoped. And we've had recent high readings from non-market services and some bumpiness for goods. So I'll just say, so remember that we coupled this decision today with the extent and timing language in the post-meeting statement that signals that we are at or near a point at which it will be appropriate to slow the pace of further adjustments. You ask about 2025. I think that the slower pace of cuts for next year really reflects both the higher inflation readings we've had this year and the expectation that inflation will be higher, You saw in the SEP that risks and uncertainty around inflation we see as higher. Nonetheless, we see ourselves as still on track to continue to cut. I think the actual cuts that we make next year will not be because of anything we wrote down today. We're going to react to data. That's just a general sense of what the committee thinks is likely to be appropriate.
Sorry, just one quick follow-up. Why, I guess, would you make those cuts? Like, what would be the trigger to cut?
So we're to cut further after this point. I would say it this way: we've reduced our policy rate now by 100 basis points. We're significantly closer to neutral. At 4.3% and change, we believe policy is still meaningfully restrictive. But as for additional cuts, we're going to be looking for further progress on inflation, as well as continued strength in the labor market. And as long as the economy and the labor market are solid, we can be cautious about as we consider further cuts. And all of that is reflected, to your question, in the December SEP, which shows a median forecast of down 2 cuts next year compared to 4 in September.
Howard Schneider with Reuters, and thanks for the opportunity to ask a question. So this does seem towards the dynamic in 2016 during the last transition to a Trump administration, where the committee saw slightly tighter policy, in part in expected anticipation of the fiscal policy stance that was seen evolving over the year. Some of it was a data mark-to-market exercise, and some of it was anticipation of fiscal. What's the split on this one? How much of this was accounting for inflation data that was coming in, and how much of it is expecting that there will be inflationary fiscal policy next year?
I'd say I'd point to 5 or 6 things, and let me start by saying that we think the economy is in a really good place, and we think policy is in a really good place. Let's remember that the economy is growing 2.5% this year, that inflation has come down by 50% from 5.6% to 2.6%. Headline inflation is 2.5% on a 12-month basis. We're actually in a really good starting place here. But since, so what's really driving the slower rate cut path? First thing is growth is stronger, right? The economy grew faster in the second half of 2024 so far than we had expected, and is expected to be above what our expectations in September next year as well. Unemployment is lower, and in the SEP you'll see that participants think that the downside risks are less and uncertainty is less. So that's more strength, right? Inflation is higher, as we talked about. Inflation's higher this year. It's also higher in the forecast next year. I'd also point out that we're closer to the neutral rate, which is another reason to be cautious about further moves. But then getting to your point, there's also there's uncertainty. Uncertainty around inflation, I pointed out, is actually higher. It's also in the case of some people, the way I would say it is this: some people did take a very preliminary step and start to incorporate highly conditional estimates of economic effects of policies into their forecasts at this meeting, and said so in the meeting. Some people said they didn't do so, and some people didn't say whether they did or not. So we have people making a bunch of different approaches to that. But some did identify policy uncertainty as one of the reasons for their writing down more uncertainty around inflation. The point about uncertainty is it's kind of common sense thinking that when the path is uncertain, you go a little bit slower. It's not unlike driving on a foggy night or walking into a dark room full of furniture. You just slow down. And so that may have affected some of the people. But as I said, there's a range of approaches on the committee.
If I could follow up on that, you mentioned the risk and uncertainty indexes toward the back of the document. The upside risk to inflation jumped quite substantially. The only thing really that's happened, you mentioned that the disinflationary story remains intact, yet the risk weighting has jumped to the upside. The only real thing that's happened is November 5th in the meantime. Is it fair to say that that's what's driving the higher sense of upside risk on inflation?
Actually, that's not the only thing that's happened. What's happened is that our forecasts for inflation for this year, I think, are 0.5 higher than they were in September. So you had 2 months of higher inflation in September and October. As I mentioned, November is back on track, but once again, we've had a year-end projection for inflation, and it's kind of fallen apart as we've approached the end of the year. So that is certainly a large factor in people's thinking. I can tell you that might be the single biggest factor is inflation has once again underperformed relative to expectations. It's still, going to be between 2.5 and 3. It's way below where it was, but we really want to see progress on inflation. To as I mentioned, as we think about further cuts, we're going to be looking for progress on inflation. We have been moving sideways on 12-month inflation as the 12-month window moves. That's in part because inflation was very, very low measured in the fourth quarter of 2023. Nonetheless, as we go forward, we're going to want to be seeing further progress on bringing inflation down and keeping a solid labor market.
Chris.
Thank you, Chris Rugier at Associated Press. Thanks for taking the question. In September 2018, the Fed staff in the Teal book discussed a policy of looking through any new tariffs as long as there were one-time increases and inflation expectations remained anchored. Could you comment on if that analysis remains effective and any other thinking on tariffs generally that you can share?
So I do think that the September 2018 Teal book alternative simulations are a good place to start. I happen to have brought them here with me today. I'm sure you have them too. They're a good starting point. And I would just say, it's 6 years old analysis, but nonetheless, this is still, I think, the right questions to ask. And, there were two simulations. One was seeing through, one was not. And I'd point you. There's some language in the see-through paragraph that says, that considers situations in which it might be appropriate to see through inflation, and then names some conditions that in which it might not be. In any case, this is not a question that's in front of us right now. We won't face that question. We don't know when we'll face that question. What the committee's doing now is discussing pathways and understanding, again, the ways in which tariff-driven inflation can affect tariffs can affect inflation in the economy and how to think about that. So we've done a good bit of work. All of us have, each of us has, and it puts us in position when we finally do see what the actual policies are to make a more careful, thoughtful assessment of what might be the appropriate policy response.
Great. And just a quick follow-up. Given the recent bout of inflation that we've been through, with consumers seeing how prices can rise and businesses seeing that they can raise prices at least for some time, does that make it a little bit riskier to look through tariffs? I mean, do you feel you have to respond more quickly to inflation threats, given what we've seen in the past few years?
So the main thing is, and this is also a point in these alternative simulations, is there are just many factors that go into how much tariffs will even go into consumer inflation. How persistent will that be? And so we just don't know really very much at all about the actual policies. So it's very premature to try to make any kind of conclusion. We don't know what will be tariffed from what countries, for how long, in what size. We don't know whether there'll be retaliatory tariffs. We don't know what the transmission of any of that will be into consumer prices. To your point as well, I wouldn't say that we know whether the last episode is or is not a good model for what happened. You pointed out we've just been through a period of high inflation. We've just gotten through that period. That's a difference. There was also quite a bit of diversion of trade away from China to other countries since that may have effects. I don't know. I just think we need to take our time, not rush, and make a very careful assessment, but only when we've actually seen what the policies are and how they're implemented. And we're just not at that stage. We're at the stage of doing what other forecasters are doing, which is kind of thinking about these questions, but not trying to get to definitive answers for some time.
Nick Timmeros of the Wall Street Journal. Chair Powell, to make sure I understand, participants today revised up their core PCE inflation projection for 25 so that the central tendency runs from 2.5% to 2.7%. And as Howard noted earlier, most of the committee sees the risks to those projections to the upside. So if inflation only declines next year from 2.8 to 2.5 to 2.7, what would compel the committee to be cutting in that situation?
Let me find these numbers. So we have we have inflation coming down, core inflation coming down to 2.5 next year. That'd be significant progress. You see a slower path. I think that does take on board that we want to see real progress, but we'd be seeing meaningful progress to get inflation down to that level. That wouldn't be all the way to 2%, but it would be better than this year. This year will be 2.8 or 2.9. That would be meaningful. We also have to think about the labor market, and while we have the labor market forecast as being in good shape, we are also mindful that it is still out there very gradually cooling so far in an orderly, gradual way. But it's also something we need to keep our eye on.
I guess if I could follow up, if somebody looked at these projections and also the insertion of the extent and timing language in the statement, which has been used at times in the past when the committee thinks maybe it's going to be on hold for a while, and they said, gee, this looks like it could be the last rate cut for some time, would they be mistaken to infer that?
So that's not any decision that we made at all. Let me explain extent and timing. So the sense of that wording is to make clear that if the economy does evolve about as anticipated, we're at a point at which it would be appropriate to slow the pace of rate cuts. So extent, that just relates to how much further we can reduce our policy rate consistent with getting to a neutral stance. Clearly, that distance has shrunk by 100 basis points, so it's significantly smaller. So that's the extent question. And we're going to be looking for further progress on inflation as well as a strong labor market to make those cuts. Timing just suggests, again, that we're at a place where we assuming the economy develops as expected, we're at or near a level that will make it appropriate to slow the pace of adjustment. So that's what we mean by that. We're not trying to make decisions about the longer run. We're trying to make sensible policy as we go. And, I just would emphasize the uncertainty, which is it's just a function of the fact that we expect significant policy changes. There's nothing really unusual about that. I think we need to see what they are and see what the effects they will have. We'll have a much clearer picture, I think, when that happens.
Mike.
Michael McKee from Bloomberg Radio and Television. Even though you've cut rates by 100 basis points this year, we haven't seen much change in mortgages, auto loan rates, or credit card rates. You say you're significantly restrictive. Are you running a risk that the markets are fighting against you and the economy could be more at risk of a slowdown than you anticipate?
So the rates that you talked about are really longer run rates, and they are affected to some extent by Fed policy, but they're also affected by many other things. And longer rates have actually gone up quite a bit since September, as you well know, and those are the things that drive, for example, mortgage rates more than short-term rates do. So we look at that, but we look at all financial conditions, and then we look at what's happening in the economy. So what we see happening in the economy, again, is, most forecasters have been calling for a slowdown in growth for a very long time, and it keeps not happening. So we're now well into another year of growth that looks like it might be 2.5%. Second and third quarters were right about at the same level. So the U.S. economy is just performing very, very well, substantially better than our global peer group. And there's no reason to think a downturn is any more likely than it usually is. So the outlook is pretty bright for our economy. We have to stay on task, though, and continue to have restrictive policy so that we can get inflation down to 2%. We're also going to be looking out for the labor market. We want to keep the labor market pretty close to where it is. We're pretty close to estimates of the natural rate of unemployment. Job creation is a little below the level that would keep it there, but nonetheless close. And so that's what our policy is trying to achieve.
If I could follow up by asking about your formulation for beginning rate cuts, included the phrase, we need to have confidence that inflation is moving down towards our target. Given the fact that you've raised your forecast for next year, do you have confidence or are you uncertain about the path of inflation going forward?
So confidence was our test for raising rates. And, we made, look at the broader sweep. We've made just a great deal of progress. We're well into the twos in core inflation and around 2.5 or even lower than that we have been for headline inflation. So I would say I'm confident that inflation has come down a great deal, and I'm confident in the story about why it's come down and why that portends well. And I'll tell you why. Again, you do see with housing services inflation, which is one that we've really worried about, it really has come down now quite steadily at a slower pace than we thought, 2 years ago. But it's nonetheless steadily coming down as market rents, as market rents start to equilibrate better with new leases that turn over, not new tenants, but new leases. Market rents is new leases. So that's happening. That process is ongoing pretty much as we expect. Goods inflation, which is another big piece of it, has returned right to the range where it was before the pandemic. Just for some months this year, it kind of moved up in a bumpy way because of used cars and things like that. But we think overall that should generally be in the range it was in. That leaves non-housing services, and market-based non-housing services are in good shape. It's non-market services, and those are services that are imputed rather than measured directly, and they don't. We think they don't really tell us much about the about tightness in the economy. They don't really reflect that. A good example is financial services, which is really done off of asset prices. And that's how that inflation works. So the overall picture, the story of why inflation should be coming down, is still intact. In particular, the labor market. Look at the labor market. It is cooler by so many measures now, modestly cooler than it was in 2019, a year when inflation was well under 2%. So it's not a source of inflationary pressures. Not to say there aren't regional and particular professions where labor is tight. But overall, you're not getting inflationary impulses of any significance from the labor market. So what's the story? The story is still just we're unwinding from these large shocks that the economy got in 2021 and 22 in, for example, housing services, and now also in insurance in particular, where costs went up, and those are now being reflected later in housing insurance. It's real inflation, but it doesn't portend persistently high inflation. So we and most other forecasters still feel that we're on track to get down to 2%. It might take another year or two from here, but I'm confident that that's the path we're on. And, our policy will do everything it can to assure that that is the case.
Colby.
Thank you. Colby Smith with the Financial Times. So the unemployment rate as of November, while still very low, is within spitting distance of the level that generated a lot of concern about the labor market over the summer in the lead up to the 50 basis point cut in September. Hiring has also narrowed to just a handful of sectors. But now the committee appears comfortable skipping cuts at upcoming meetings. So what has changed about the committee's assessment of the risks confronting the labor market? Is there just less concern now on that front, or is it just about there being more upside risk to inflation that now needs to be accounted for?
The unemployment rate is now the same as it was in July, 4.2%. It's moved up and down, but it's now the same as July. And job creation is lower than it has been, but it's been steady. It's not declining. It's steady at a level which, as I pointed out a couple of times, is actually below the level that would hold the unemployment rate constant, but it's not so far below. So you might, if we have the break-even level right, and if job creation continues at that level in the establishment survey, then you would get a tenth maybe every other month kind of thing. So gradually declining. We don't have that kind of precision in this. So you're right, though, and I read out some of the reasons. We do think the labor market is still cooling by many measures, and we're watching that closely. It's not cooling in a quick or in a way that really raises concerns. I think you pointed out participants in the FOMC really thought that the risks and uncertainty had improved relative to the labor market, and it's because things have just gotten a little bit better. It doesn't, the unemployment rate flat and things like that. Nonetheless, we're watching it closely.
If the idea, though, is that no additional kind of softening in the labor market is welcome here, what's to prevent that from happening if rates are still restrictive?
So what I said is we don't think we need further softening to get to 2% inflation. That's what I'm saying. Not that it's not welcome. We don't need it. We don't think. If you had a situation where inflation is moving around by 1/10 every few months, that's, we'd have to weigh that against the fact that inflation has in recent months been moving sideways in the 12-month window. And so we've got to weigh them both. And at this point, for a while there, we were only really focused, mainly focused on inflation. We've now gotten to a place where the risks of the two are we think are broadly, roughly in balance. And so that's how we think about it.
Steve.
Mr. Chairman, I did not hear you use the word recalibration today. And I'm just wondering if the recalibration phase is over and what you might call this new phase and whether the criteria for changing rates is somehow different and higher than it was before. Thanks.
We're not renaming the phase yet, but we may get around to that. But no, I would say we are, though, in a new phase in the process, as I said. So, and that's just because we've reduced our policy rate by 100 basis points. We're significantly closer to neutral. We still think where we are is meaningfully restrictive. And I think from this point forward, it's appropriate to move cautiously and look for progress on inflation. We've done a lot to support economic activity by cutting 100 basis points, and that's a good thing. I support the decision, and I think it was the right decision to make. I think from now, we are in a place where the risks really are in balance, and we need to see progress on inflation, and that's how we're thinking about it. So it is kind of a new thing. We moved pretty quickly to get to here, and I think going forward, obviously, we're going to be moving slower, which is consistent with the SEP.
I wonder if I could follow up and ask you how much you or the committee are looking through some of the high numbers we've had in the recent inflation numbers. For example, cars being up maybe because of the hurricanes, eggs because of the avian flu, that kind of stuff, and then looking forward perhaps to housing inflation coming down as it did in the recent report.
So we always try to be careful about not throwing out the numbers we don't like. It's just an occupational hazard is to look, those high months are wrong. What about the low months? We have a very low month potentially in November. It's estimated by many to be in the mid-teens for core PCE. So that could be idiosyncratically low. We try to look at not just a couple or 3 months. We shouldn't have our position shouldn't change based on 2 or 3 months of good or bad data. We have a long string now of inflation coming down gradually over time. As I mentioned, 12-month headlines 2.5, 12-month core is 2.8. That's way better than we were. We still have some work to do, though, is how we're looking at it, and we need policy to remain restrictive to get that work done, we think.
Neil.
Thanks, Chair. Thank you, Chair Powell. Neil Irwin from Axios. Financial markets have been very buoyant really all year. Is the committee comfortable with where financial conditions are, or do you see a risk that looseness in financial conditions could undermine progress on your inflation target?
So we do look carefully at financial conditions, of course. That's part of what we do. But, we really look carefully at is the performance of our goal variables and how are we affecting the economy. So what we've seen over the course of just take the last year, we've seen inflation over the last couple of years come down a lot. We've seen the labor market cool off quite a bit. That suggests that our policy is restrictive. We can also look more directly at the parts of the economy that are affected by that are interest sensitive, like particularly housing. Housing activity is very low, and that's partly significantly because of our policy. So we think our policy is working, it's transmitting, and it's having the effects on our goal variables that we would want. A lot of things move financial conditions around, as you know, and we don't really control those. But I'd say we see the effects we're hoping to see on the goal variables and the places where we'd expect to see it.
So if I may, speaking of assets that have been buoyant, do you see any value or benefit in the U.S. government building a reserve of Bitcoin?
We're not allowed to own Bitcoin. The Federal Reserve Act says what we can own, and we're not looking for a law change. That's the kind of thing for Congress to consider, but we are not looking for a law change at the Fed.
Andrew.
Hey, happy holidays, Mr. Chairman. Thanks for taking our questions. I was wondering if you are satisfied with the way 2024 is ending, if you're confident that we've avoided the recession that forecasters were predicting as inevitable a couple years ago.
I think it's pretty clear we've avoided a recession. I think growth this year has been solid. It really has. PDFP, private domestic final purchases, which we think is the best indicator of private demand, is looking to come in around 3% this year. This is a really good number. Again, the U.S. economy has just been remarkable, and it's when in these international meetings that I attend, this has been the story, is that how well the U.S. is doing. And if you look around the world, there's just a lot of slow growth and continuous struggle with inflation. I feel very good about where the economy is and the performance of the economy, and we want to keep that going.
The other thing I just wanted to ask about was you guys have noted that the unemployment rate is still low. However, employment rates have fallen rather quickly. The prime age employment rate has fell by about 0.5% rather recently. The question, I guess, is, do you think there's maybe more downside momentum in the labor market than the unemployment rate alone is signaling?
I don't think so. No, I think overall, if you look at it, prime age participation is still very high. What's going on in the labor market is that the hiring rate is low. So if you have a job, you're doing very well, and layoffs are very low, right? So people are not losing their jobs in large numbers, unusually large numbers. If you are looking for a job, though, the hiring rate is low, and that's a signal of lower demand. It has come down. So we look for signs like that, and that's clearly a sign of softening, further softening. I didn't mention it earlier, but I think you can see an ongoing gradual softening in the labor market. Again, not something we need to see to get 2% inflation, and that's part of the reason that explains why we moved ahead today with the action with an additional cut. So, but you take a step back, the level of unemployment is very low. Again, participation is high, wages are at a healthy and ever more sustainable level, wage growth, and so the labor market, this is a good labor market, and we want to keep it that way.
Thanks.
Amira.
Thank you. Amara Mokway from Bloomberg News. I just want to put a finer point on the labor market. Can you keep the labor market this way, in the strong position that you have described, without further cuts? In other words, do you still view the labor market as needing support to protect against a further cooling?
We can't know that with any tremendous certainty. I will say that we think that our policy balances the risks. We think the risks are roughly in balance as between the two mandates, and we think the labor market is in solid shape. And when I say it's softening or cooling, it's a very gradual process. Job creations are meaningfully positive. Wages are, if anything, still a bit above what would be sustainable if productivity were to revert to its longer run trend. If you take into account the high productivity readings we've had, then wages are already at a sustainable level relative to 2% inflation. So I don't want to overstate the downside in the labor market, because the downsides clearly appear to have diminished. Nonetheless, it's one of our mandate goals, and we pay close attention to it, and it's worth noting that it is still gradually cooling, and in an orderly way. And that's how I would characterize it, and that's why we're paying careful attention.
Elizabeth.
Thanks so much, Chair Powell. Elizabeth Schulze from ABC News. As you've noted, the Fed is now forecasting higher inflation next year. High prices are still a burden for so many households right now. Why do you think it is that inflation is proving to be more stubborn than you'd expected?
It breaks down into a long answer if you want, but it just has been a little bit more stubborn. I think if you go back 2 or 3 years, many people were saying that to get this far down, we would have had to had a deep recession and high unemployment by now. Well, that has not been the case. So, the path down has actually been much better than many predicted. We've managed to have the unemployment rate remain essentially at its longer run natural rate while inflation has come down from, core PCE inflation has come down from 5.6% to 2.8% on a 12-month basis. So that's a pretty good outcome. Why hasn't it come down? One reason is that just a technical issue around the way we calculate housing services, and that process has been slower than market rents are showing up more slowly in that measure than we might have thought 2 years ago. So that's part of it. I think there are other parts of the story, but what I think people are feeling right now is the effect of high prices, not high inflation. So we understand very well that prices went up by a great deal, and people really feel that. And it's prices of food and transportation and heating your home and things like that. So there's tremendous pain in that burst of inflation that was very global. This was everywhere in all the advanced economies at the same time. So now we have inflation itself is way down, but people are still feeling high prices. And that is really what people are feeling. The best we can do for them, and that's who we work for, is to get inflation back down to its target and keep it there so that people are earning, big real wage increases so that their wages are going up, their compensation is going up faster than inflation year upon year upon year. And that's what will restore people's good feeling about the economy. That's what it will take, and that's what we're aiming for.
And as we look ahead to next year, what do you see as the biggest challenge to the economy under the next administration?
I feel very good about where the economy is. Honestly, I'm very optimistic about the economy, and we're in a really good place. Our policy's in a really good place. I expect another good year next year.
Edward.
Thanks, Chair Powell, for doing the questions. Edward Lawrence from Fox Business. So you say that we're closer to the neutral rate. What percent do you see and the committee believes, where is that neutral rate?
So I'll say a couple of things. First of all, when we write, the thing we write down in the summary of economic projections is the longer run neutral rate, which is the neutral rate at a time when supply and demand are in balance, the full economy is in balance, and no shocks are hitting the economy. That is not where we are right now. So when we're making monetary policy at the Fed, that's not the question we're asking. So you can't do a straight read between those longer run numbers that we write down and what we think the appropriate policy should be. So basically, at any given time, various shocks are hitting the economy. And so what we're doing in real time is we're looking at our policy stance, and we're looking at the way it's hitting the economy. And particularly, we look at the effects it's having as we try to move the economy toward maximum employment and price stability. And the answer can be, there are things that affect the economy that are lasting, but not permanent. And the ones that are permanent are the ones that would be in our star. The ones that could be lasting, but nonetheless go away over time, they could actually affect what's sort of technically the appropriate neutral stance in near term. So we're looking at that, and we don't know exactly where it is, but as I like to say, we know it by its works. And I think what we know for sure is that we're 100 basis points closer to it right now. There are many estimates of where that might be, and we know we're a lot closer to it. And I think we're in a good place, but I think from here, it's a new phase, and we're going to be, cautious about further cuts.
But I think that the markets are looking for a little more clarity. I mean, I've heard estimates from 2.9% to 4%. I think the markets would like to see a little more clarity about a year out, 18 months out, as to where that goalpost, for lack of a better term, is, because at the moment it looks big.
Yeah, I mean, honestly, there are countless models of what a neutral rate might be at any given time. There are empirical models, there are theoretical models, there are things that combine them, and they have as many different answers as you'd like. So there is no real certainty. And I mean, it's actually a good thing to know that we don't know exactly where it is. So you're not tempted to think, oh, I think this model or this estimate is right. You just have to be open to the empirical data that are coming in, and also how it's affecting the outlook. And it's not made any easier by the fact that that our policy works with long and variable lags. Nonetheless, that is the job we have, and so I think it's appropriate for us now to proceed cautiously. Now that we're 100 basis points closer to neutral, and we'll do so. Meanwhile, the economy seems to be in good shape, and these cuts will certainly help to support economic activity and the labor market. while we can still make progress on inflation because policy is still meaningfully restrictive.
Victoria.
Hi, Victoria Guida with Politico. I just wanted to make sure I understood what you were saying at the beginning about inflation. Are you saying that progress on core PCE counts as progress on inflation, even if headline inflation ticks up? And then also, since that's what's projected in the SEP, I was wondering what accounts for that? Why do you all see core PCE going down and potentially headline inflation ticking up?
So, and as I imagine the goal overall is headline inflation because that's what people experience. People don't experience core inflation; they experience inflation, and that includes food and energy costs. So that's the overall goal. But as we know, headline inflation contains energy and food, and those prices can fluctuate for reasons that are not related to tightness in the economy and therefore are not really good predictors of future inflation. So it turns out that core inflation is a better predictor of overall inflation than overall inflation is. So we look at core inflation because it's a better measure of what future inflation is likely to be because it's a better measure of what inflation pressures exist. So that's it's complicated, but ultimately our goal is headline, not core. So your second question was what?
Why do you all see core going down, but headline potentially ticking up?
So headline can be affected. You're talking about next year.
Mm-hmm.
Yeah. So headline can be affected by energy prices and food prices. So that there will be things in the headline forecast that are to do with forecasts of energy prices, whereas core will be, if you look at core going out a full year, then it'll be much more driven by things like tightness in the economy. That's why the two can go in different directions. Headline has been lower, as you know, most of this year. But that's because energy prices have been coming down, which is a great thing for people. But energy prices will come down and then they will go up, and it won't really be telling us anything about how tight the economy is and how future inflation will perform.
Do geopolitical risks factor in at all to how you're thinking about energy prices?
We monitor geopolitical risks really quickly, but really carefully rather. But I would say so far those risks nothing has come out of those risks that has really been important for the United States economy. The single thing that you would look to is the price of oil, given that we're talking about the Middle East and Ukraine, but that is a good summary statistic for the kind of thing that could go wrong with global turmoil. But the price of oil has been coming down, and because of global supply conditions. So the U.S. is not feeling really the effects of geopolitical turmoil, but we are certainly at a time of elevated geopolitical turmoil, and it remains a risk.
Kelly.
Thanks, Chair Powell. Kelly O'Grady from CBS News. I want to go back to something that you said a minute ago, that wage growth is outpacing inflation now. It wasn't the case for some time, of course. It's partly why Americans haven't felt much relief in their wallets from prices yet. But with inflation ticking up, how worried are you the progress in closing that gap could go away?
Yeah, so inflation, again, we don't overreact to a couple of months of higher readings or a couple of months of lower readings. And what we had was we had 4 months of really nice readings, and then September and October were higher, but then November is much lower. So I don't really think the public is experiencing that as a surprising upside risk to inflation. I think inflation is much lower. What the public is feeling, and they're right about it, is that prices are just, the price level went up because of the past inflation. And it's going to take some time for real wages to recover over a period of years in which your real compensation is growing. And in other words, your compensation is growing meaningfully faster than inflation. That's exactly the kind of economy we have now. And we just want to hold on to it. That process will probably take some years, but that's what's going on right now. And I don't think that a couple of months of higher inflation really signal that anything of the nature you're suggesting.
And just one follow up. Let's look more long term. You previously predicted hitting the 2% inflation target in 2026. It's now been pushed out to 2027. You said you're focused on enabling further progress on inflation. That's not necessarily progress in the right direction. Are you confident that target isn't going to move further out?
We're talking about when you're projecting the economy, 3 years out, 2 years out, you're talking about high uncertainty. Very high uncertainty. We really, at that point, that's not possible to confidently predict where the economy is going to be in 3 years. So what we're doing is we're looking at what's happening now. We're kind of projecting that the same kinds of things are happening. So we keep a strong labor market. Housing services inflation comes down. Goods inflation settles down, and non-market services return to their prior level. All of those things should happen over time, and those pieces come together. There's every reason to think that they will. The timing of it is highly uncertain. But you're not wrong though that it's been a bit frustrating because while we've made progress, it has been slower than we had hoped. Nonetheless, we're still on track, and I think if 2 years ago you'd said we were at 4.2% unemployment and 2.8% inflation, people would say, "I'll take that." I mean, that's a pretty good interim place to be. Job's not done, but I think we're feeling good about where we are and where we're headed.
Go to Nancy for the last question.
Hi, Chair Powell, Nancy Marshall-Genzer from Marketplace. You said a couple times inflation has been moving sideways. Appears to be settling in around, 2.5%. Do you think the Fed is just going to have to settle for that and accept that you're not going to get to your 2% target?
No, we're not going to settle for that. I think we certainly have every intention and expectations that we'll get inflation back sustainably to 2%. That is, and I am confident we will achieve that. It has taken longer, but you have to be, we are making progress. We have made a great deal of progress, and we'll continue to do so and get back to 2% inflation. That's what we owe the public, and we're committed to achieving it.
In that case, can you rule out a rate hike next year?
You don't rule things completely in or out in this world. That doesn't appear to be a likely outcome. I think we're at 4.3%. That's meaningfully restrictive, and I think it's a well-calibrated rate for us to continue to make progress on inflation while keeping a strong labor market. So, thank you very much.
All right.
Thanks, Nancy. Back to Kelly.
Yeah, thanks. I swear he was flirting with Kelly at the end of that. He was just like going on and on. Anyways, what did you think, Matt?
Well, I'm glad we could have share a laugh together, considering I'm down like 70 grand. But
it's just numbers on a screen, baby.
It's just number on a screen. The tear in my left eye is due to the laughter, not the actual amount of money that I'm down. But hey, man, I mean, I'm actually kind of happy. I've been looking forward to a day where we actually see a pullback.
Yeah.
But I think it makes sense, man. I mean, we've been on such a run and tear for quite some time, and I've honestly been wondering if we were even going to have the December cut at all, if there was going to be a pause. And I think that what caught the market by surprise, maybe not necessarily is the movement from 3 cuts to 2 next year, the forecast of that, but actually more along the lines of that they almost didn't do a cut today. And so I'm kind of curious when notes come out in January, what the voting was. How close was it? Was it 50-50 almost, or was it 70-30? So I'm kind of curious what that means, and if the notes come out as hawkish as Jerome did today. So I'm curious to hear your thoughts.
Well, I mean, look, I took a couple of notes, but overall, I thought he was sounding really neutral, exactly how we mentioned before going into the comments in the first place, where we were saying, hey, look, it's prudent for him to open the door to have fewer cuts because there's a lot of things that can go wrong next year. I mean, I thought it was interesting that he said, hey, I'm essentially very bullish on the economy. expecting another good year. And, their expectations now have inflation going or being higher in 2025 than it was going into this call. But, he said the economy is in a really good place, substantially better than our peer group, which I had a little chuckle because I thought of Canada. Growth is stronger. Outlook is bright for the economy. Some Fed members, I found this interesting, that some Fed members wrote policy uncertainty to account for their stance on how many cuts next year. If there's more uncertainty, you want to go slower. I think everybody sort of knows that, because you want to be more conservative heading into something where you're going blind. Policy uncertainty, and then immediately they were asked about tariffs and essentially about Trump coming in, because we've had a Trump administration in the past, and there will be severe policy differences between the current administration and the new one. And so that could obviously have an impact, which will impact rates, which, I think is interesting. I think the tariff conversation as well is interesting. He talked about retaliatory tariffs and, what that could mean for the economy and how that could affect the end consumer and make the Fed's job, or at least make the projections different than what they had before. But honestly, I thought it was kind of bullish. I mean, I found it interesting that like a lot of people were very bearish in the chat because they're like, oh my God, everything's going to zero. And people are coming out with the memes of like the Grinch with Powell's face on it and stuff. And I'm like, guys, like, I don't think you guys understand, like, if they're cutting slower, it means the economy is in a better spot. It means it's more stable. If they're cutting like 50 bips at, 75, like if they're rushing and cutting at a fast pace, it means the economy is worse. I mean, he flat out said in the commentary, he's like, we've avoided a recession. I'm very optimistic about next year. And that's exactly what people wanted for the, majority of 2024. They were talking about like a soft landing as the best case scenario. And now they're like, well, he didn't have enough rate cuts next year. It's like, guys, you're getting like drunk on the cough syrup. Like, dude, just take it easy. Like the economy is in a better space. It's more sustainable to have over the long term. Like I agree, whatever, great. We're going to get a day or 2 days of a pullback, but overall, like you have to look at the forest and not the trees, right? You have to zoom out a little bit and see this for what it is, which is, them going to a more neutral stance and them saying, hey, we're keeping the door open. If the economy is worse, if jobs are worse, if the labor market conditions worsen, if tariffs affect this negatively, if inflation goes back up, yeah, sure, we'll cut more. But if not, then we're going to cut less because we don't need to cut as much. And I think that as a through line is a much better message that underlines the health of the economy. But then you have all of these degens who are like, wait a minute, I don't give a fuck about the economy really, because my calls are, underwater now or whatever it may be. And the reality is that, the Fed is looking out for the economy first and foremost. And a lot of people were saying that, hey, we want the economy to be better because a recession is not great for markets. And that's exactly what's happening. And now they're like, well, we'd love more rate cuts. It's like, guys, just pick and choose what you want,
Yeah, I think I think Jerome kind of said it. I mean, when you're talking about where we were in September compared to where we are today, people have kind of gotten drunk since November 5th and recognizing the different regime change. And so I'm actually kind of curious, just noting the next FOMC meeting is January 29th next year. That's 9 days after Trump gets sworn in. I mean, does this solidify Jerome on his way out? Because I know that at least one of the things that Uncle Donnie kind of pulled on, or at least, pushed for, was more rate cuts rather than few. And so this goes from 3 to 2. That's against what Uncle Donnie wants. And so is that something that that's there? I also noted a few things about the Bitcoin reserve and where does JP sit on that? And obviously he states at the moment that there's law that they can't hold Bitcoin and they're not looking to change the law, but I'm curious if that's something that ends up changing. And it's not obviously up to the Fed necessarily to hold it on their books. It could be held, I guess, elsewhere within the Treasury. Maybe I'm not exactly too sure how that back end piece works, but there was that statement. But I am kind of curious as well. I mean, there is, like you stated, a lot of different things that can happen, right? The tariffs can play an impact. We've already kind of seen the turmoil that's going on in Canada. What's going on with that, and
Well,
who
so
knows
let me just super quick comment on that because it links into this comment by Emil. ECB cut because the situation in Europe is worse than in the US. In Canada, they had like another 50 basis point cut, and then they had the gall to go up and step in front of the camera and say, we actually have cut the most out of all G7 countries, so we're a leader in that. And I'm like, you guys are fucking idiots. Like, people are cutting because the underlying situation is worse. Like the speed of the cuts is inversely proportionate to how bad the situation is. And I think that's the thing that I really want to drill in the heads of people watching is like, look, if they're being more stair-stepping downwards, it's actually a good thing for the economy because it has longevity in this move. You're getting that soft landing you're asking for. Other economies around the world, Europe, Canada, and others are having to cut fast, not because they necessarily want to, but they're having to. And then they come out and they play it as a good thing. Like, hey, we're actually the leader in cutting. It's like, well, okay, good for you, I guess.
Yeah.
Sorry, continue.
No, I just want to state the status of the markets. Obviously, we're at 593 on the SPY, so about 59.30. We obviously started today at about 605, 603 on the SPY, so down about 8 to 10 points there. So it's about 1.87, and it looks like it's continuing to drop. Bitcoin back down at massively low prices over the. No, I'm just joking. Flat week over week rather. So we started off this week before the rally going all the way to 107, 108. Now we're back down to 101 and a half. So basically we're eliminating all those gains that we've seen over the past 4 days on Bitcoin. I am curious. Obviously, my calls have been absolutely destroyed. I thought about closing them at 50%, and then I was just like, what's the worst that happens? I mean, that's $500 down the drain. That's fine. I guess my question is for me, I'm excited. The broader portfolio has needed to come down. I mean, my portfolio is at all-time highs, and I've been looking for an opportunity for the market to come down because it's been hard to find good deals. And so hopefully with this, it persists maybe over the next couple of weeks. We get maybe a 5%, 10% pullback, and then maybe 20% in some other select names. And hopefully some of those names are in my wheelhouse and I'll be able to add to them because it's been hard. Like, I'm excited. Rocket Lab's back down below $24 or at $24. So for me, that's always a win. I'd like to add, closer to $20 if I could. So
I do also think it's going to be short-lived. I honestly think that like as early as tomorrow, in many cases, we might be back to green. Obviously not regaining all of the losses that we have today, but I do think that sentiment in the market is still high because the outlook from the economy and others is optimistic, and the sentiment in the market reflects that. And so, sure, we might have a red day tomorrow. Maybe we might have a red day Friday as well. But like, I do think that after this is priced in, that the market is still going to be going up. Maybe not to the same degree with the same violence that it has been, the volatility before, but directionally speaking, I think we're still higher. So we'll see. I mean, maybe we don't have as strong of a Christmas rally, but I still think we will have something in the market that we won't like just